According to the Federal Reserve's most recent survey of consumer finances, the most comprehensive wealth study conducted in the United States, the median American net worth at age 35 is $46,000. At age 45, it is $168,000. At age 55, it is $290,000. At age 65, the traditional retirement milestone, it is $409,000. $409,000. In a country where most financial planners say you need between $1.5 and $2 million to retire comfortably, the gap between where the average American actually is and where they need to be is not a small miscalculation. It is a systematic shortfall, and it is driven by the same forces that personal finance content almost never discusses directly. Not how much Americans earn, but specifically where they fall behind at each age milestone, and what the highest net worth 25% of Americans are doing differently at each stage. This video uses Federal Reserve data to show you exactly where you stand and what it takes to move from the median to the top 25%. We are covering the real Federal Reserve net worth numbers at every decade of life, the critical difference between median and mean that most published statistics get wrong, the specific behaviors that separate the top 25% from the median at every age, and a simple formula to calculate your own target net worth for your current stage. This is Wealth Clarity. Let's get into it. Let's go through the Federal Reserve data decade by decade, because the numbers at each stage tell a different story, and understanding the trajectory matters as much as understanding any single milestone. Under 35. The median net worth for Americans under 35 is $39,000. The mean, which we will explain shortly, is $183,000. The top 25% of this age group has a net worth above $250,000. The primary drivers of net worth in this group are student loan debt, which is the single largest liability for under 35s, home equity for the minority who own property, and the beginning of investment account balances for those who started early. Ages 35 to 44. Median net worth rises to $135,000. Top 25% is above $500,000. This is the decade where the wealth gap between those who started investing in their 20s and those who delayed becomes dramatically visible. An American who invested consistently through their 20s and early 30s may have accumulated $400,000 to $500,000 in investment assets at this stage. Someone who started at 35 is just beginning. Ages 45 to 54. Median net worth is $247,000. Top 25% is above $1 million. This is the decade where home equity becomes a major component of net worth for most Americans, and also the decade where the consequences of high-interest consumer debt become most costly for those who carry it into their 40s. Ages 55 to 64. Median net worth is $366,000. Top 25% is above $1.8 million. This is the decade immediately preceding traditional retirement. The gap between the median and the top quartile is now over $1.4 million, driven almost entirely by 3 decades of investment compounding for those who started early versus 3 decades of inconsistent or absent investment for those who did not. Ages 65 and over. Median net worth is $409,000. Top 25% is above $2 million. At the traditional retirement milestone, the median American has less than half of what most financial planners recommend as a minimum for a comfortable retirement without supplemental income. Before we go further, here is how to use these numbers for yourself. Pull up your phone calculator and do this right now as you watch. Add up everything you own at current value: your savings and investment accounts, your home equity if you own property, your car value, and any other assets. Then subtract everything you owe: your mortgage balance, car loans, student loans, credit card balances, and any other liabilities. The number you are left with is your net worth. Now find your age group in the Federal Reserve data I just walked through. Are you above the median for your age? Below it? In the top 25%? That single comparison tells you more about your actual financial position than your income, your salary, or your title ever will. Take 30 seconds and calculate it now. The rest of this video will mean more once you know your number. Here is one of the most important distinctions in understanding wealth statistics. and the reason most published figures on American net worth are misleading. There are two different ways to calculate an average. The mean takes every number and divides by the count. The median takes the middle value, the number where exactly half the population is above and half is below. For wealth data, these two figures produce dramatically different results, because American wealth is extremely concentrated at the top. A handful of billionaires raise the mean significantly without reflecting the experience of the typical American. Here is what that looks like in the Federal Reserve data for Americans aged 35 to 44. The median net worth for this age group, the number where half of Americans in this bracket have more and half have less, is $135,000. The mean net worth for the same age group, the number you get by adding up all wealth and dividing by the number of households, is $549,000. Same age group, same Federal Reserve survey, 135,000 versus 549,000. The mean is 4 times higher than the median because the wealth of the top 1% pulls the average up dramatically while the typical American sits well below it. When you see a news headline saying, "The average American net worth at age 40 is $500,000," that is the mean. It is not wrong as a calculation, but it is not describing the experience of the typical American. The median is the number that tells you where most people actually are. And as we have seen, most people are significantly behind where they need to be. Here is the insight that changes how you read every personal finance statistic you will ever see. When a financial product, a financial institution, or a news outlet tells you the average American has some amount of money, ask immediately, is that the mean or the median? If it is the mean, it is almost certainly being influenced by extreme wealth at the top. If it is the median, it is telling you what the typical American actually experiences. The Federal Reserve publishes both. Most media reports only the mean, because it is the larger, more impressive number. And reporting a larger number serves a specific purpose. It makes most readers feel behind relative to a benchmark that very few people actually meet, which sells financial products and generates anxiety-driven engagement. Understanding this distinction makes you a more sophisticated consumer of financial information, and that sophistication compounds. Now let's talk about what the Federal Reserve data actually shows about the behaviors that separate the top 25% from the median at each life stage, because the gap is not primarily about income. The Federal Reserve research consistently identifies 4 factors that distinguish high net worth households from median net worth households at equivalent income levels. The first is early and consistent investment. Americans in the top 25% of net worth for their age group began investing in retirement accounts, index funds, or both, significantly earlier than median net worth Americans. The compounding advantage of starting at 25 versus 35 is not linear. It is exponential. At equivalent income levels and contribution amounts, the earlier starter has dramatically more wealth by every subsequent decade. The second is low consumer debt. The Federal Reserve data shows that high net worth households at every age carry significantly less high interest consumer debt, credit card balances, personal loans, car loans on depreciating vehicles than median net worth households. This is not primarily because they earn more. It is because they allocate income toward assets rather than liabilities more consistently. The third is home ownership with equity. At every age milestone above 35, home equity is a significant component of net worth for the top 25%. This does not mean everyone should prioritize buying a home. The decision depends heavily on local markets, mobility needs, and opportunity cost relative to investing. But the data does show that Americans who bought property in their 30s and maintained it without extracting all the equity tend to have significantly higher net worth by their 50s. The fourth is income diversification. High net worth households are significantly more likely to have multiple income streams, a primary salary supplemented by investment income, rental income, side business income, or some combination. This is both a cause and an effect of wealth accumulation. Diversified income builds wealth faster, and accumulated wealth generates additional income streams. Here is the number that most Americans do not want to calculate but should. Thomas Stanley and William Danko, the researchers behind the Millionaire next door, developed a simple formula for determining whether your net worth is where it should be for your age and income. Multiply your age by your annual pre-tax income. Divide by 10. That is your expected net worth given your age and income level. If your net worth is above that number, you are building wealth efficiently. If it is below that number, and most Americans will find it is, you now have a specific calculable target. A 35-year-old earning $80,000 a year should have a net worth of approximately $280,000 by this formula. If you are 35 earning $80,000 and have a net worth of $135,000, the Federal Reserve median, you are below the target. That gap tells you something specific about the priority your money has been given over the previous decade. The path from median to top 25% net worth is not mysterious. Once the Federal Reserve data makes it visible, it comes down to 3 compounding decisions applied consistently over time. The first decision is investment priority. Americans who reach the top 25% net worth threshold for their age invest consistently and automatically as a non-negotiable percentage of income, rather than investing whatever is left after spending. The 15% retirement contribution guideline from most financial planners reflects this. If you are not consistently investing at least 15% of gross income toward retirement across your 401k and Roth IRA, you are unlikely to reach the top quartile by traditional retirement age on a typical American income. The second decision is debt avoidance and elimination. Every dollar in high-interest consumer debt is a dollar that cannot compound at the market rate. Americans who reach the top 25% by their mid-40s typically eliminated credit card debt and consumer loans in their 30s and have not rebuilt them. The sequencing we have covered in previous videos, 401k match first, then high-interest debt elimination, then Roth IRA contributions, then additional investing, reflects the optimal path. The third decision is net worth tracking. Americans who actively track their net worth, who know their number, watch it monthly or quarterly, and make financial decisions based on whether they improve or damage it, build wealth significantly faster than those who manage by income and spending alone. The act of measuring changes the behavior. If you are not tracking your net worth, you are navigating without a dashboard. The gap between the median American's net worth and the top 25% is not luck. It is not primarily income. It is these 3 decisions, applied or not applied, across the same decades that every American lives through. Here are the Federal Reserve numbers, the real ones. Under 35, median net worth of $39,000. Top 25% above $250,000. 35 to 44, median $135,000. Top 25% above $500,000. 45 to 54, median $247,000. Top 25% above $1 million. 55 to 64, median $366,000. Top 25% above $1.8 million. 65 and over, median $409,000. Top 25% above $2 million. The median American reaches traditional retirement age with less than a quarter of what the top 25% has accumulated. The difference is not income. It is early investment, low consumer debt, and consistent net worth tracking, applied across 3 to 4 decades. The Stanley-Danko formula gives you your personal benchmark. Age times annual income divided by 10. That is your target. Calculate it, compare it to your current net worth, and you now know exactly whether you are building wealth at the pace your future requires. If this gave you a clearer picture of where you stand and where you are going, subscribe to Wealth Clarity. New videos every Wednesday and Saturday. YouTube is going to show you the perfect next video right now. I will see you there.